What if the United States is not winning a trade war with Canada? What if it is losing an entire continent? Because right now, Canadian oil that used to flow south is heading to China. Canadian lithium that American car companies need is being processed in Beijing. Canadian uranium that powers American nuclear plants is suddenly a lot more expensive. And the tariffs that were supposed to fix this, according to the actual trade data, they are accelerating every single trend they were designed to stop. This is the story nobody is telling you. Here is a number that should make every American who drives a car, heats a home, or buys groceries deeply uncomfortable. 43%. That is the share of total United States imports that came from Canada in 2024 for crude oil alone, according to the US Energy Information Administration. Canada is not just a trading partner. Canada is the largest supplier of foreign energy to the American economy. And as of March 2025, that relationship is fracturing in ways that most people have not fully processed. Because while Americans were debating domestic politics, something shifted north of the border, something that trade economists are now calling the most significant realignment in North American commerce since NAFTA was signed in 1994. Canada started looking east, toward Beijing. And when Washington noticed, it did not respond with diplomacy, it responded with tariffs. But here's the part that almost no one is talking about. Those tariffs might be doing the exact opposite of what they were designed to do. They might be accelerating the very outcome they were meant to prevent. Let me show you how. To understand what is actually happening, we need to rewind to February 2025, because that is when the dominoes started falling. On February 4th, 2025, President Trump signed an executive order imposing a 25% tariff on most Canadian goods entering the United States. This was confirmed by the White House press office and reported simultaneously by Reuters, Bloomberg, and the Associated Press. The tariffs applied to industrial goods, agricultural products, metals, and manufactured components. A separate 10% tariff was placed on Canadian energy imports, including crude oil, natural gas, and refined petroleum products. The official justification, according to the White House statement, was national security and trade imbalance concerns. But the timing was notable. These tariffs came just weeks after reports surfaced that Canadian officials had been in preliminary discussions with Chinese trade representatives about expanding bilateral economic cooperation. According to Global Affairs Canada, formal exploratory talks began in late 2024, focused on critical minerals, electric vehicle components, and agricultural exports. These were not secret negotiations. They were announced in a December 2024 press release from the Canadian Ministry of International Trade, but they received almost no American media coverage at the time. Washington noticed, and Washington responded. Now, before we go further, you need to understand how tariffs actually work in practice, because the textbook explanation misses the point. A tariff is a tax, but it is not a tax paid by the exporting country. It is a tax paid by the importing company, and ultimately by the consumer. When the United States places a 25% tariff on Canadian aluminum, American manufacturers who need that aluminum pay the 25% premium. They then pass that cost forward in the form of higher prices on cars, appliances, construction materials, and consumer goods. According to the Peterson Institute for International Economics, the 2018-2019 steel and aluminum tariffs cost American consumers approximately $900,000 per job saved in protected industries. That analysis was published in 2020 and has been cited in subsequent Congressional Budget Office reports. So tariffs are not free. They are a policy choice with measurable costs. The question is whether the strategic benefit outweighs the economic pain. And that is where this story gets complicated. Let us talk about what Canada actually has that matters. According to Natural Resources Canada, the country holds the third largest proven oil reserves in the world, behind only Venezuela and Saudi Arabia. Most of that oil sits in the Alberta oil sands and has historically flowed south through pipelines like Keystone and Enbridge Line 5. But oil is not the only resource at stake. Canada is also the world's second largest producer of uranium, according to the World Nuclear Association. It ranks among the top 5 global producers of potash, which is essential for fertilizer. And critically, Canada possesses significant deposits of lithium, cobalt, nickel, and rare earth elements, the exact minerals needed for electric vehicle batteries and renewable energy infrastructure. According to a 2024 report from the International Energy Agency, demand for lithium is projected to grow by over 40 times current levels by 2040 if global climate commitments are met. Cobalt demand is expected to increase by 20 times. And right now, China dominates the processing and refining of these minerals, controlling over 70% of global lithium-ion battery production. This is the context that makes the Canada-China trade discussions so significant. Canada has the raw materials, China has the processing capacity and the manufacturing scale, and the United States is caught in the middle, applying tariffs that may be pushing these two parties closer together. Here's where we need to zoom in on what has actually been confirmed versus what remains projection. As of April 2025, Canada and China have not signed a comprehensive free trade agreement. That is important to state clearly. What has happened, according to statements from the Canadian Trade Minister's office in March 2025, is a series of memoranda of understanding covering specific sectors. The first, signed in January 2025, covers critical mineral exports. Under this MOU, according to reporting from the Globe and Mail, and confirmed by the Ministry of Natural Resources, Canada agreed to expedite export permits for lithium, cobalt, and nickel shipments to Chinese processing facilities in exchange for Chinese investment in Canadian mining infrastructure. The second MOU, signed in February 2025, covers agricultural products, specifically canola, wheat, and pork. Canada has long struggled with Chinese import restrictions on these goods, dating back to a 2019 dispute over canola seed quality. The new MOU, according to Agriculture and Agri-Food Canada, removes several of these barriers. A third MOU, reportedly in negotiation as of March 2025 according to Reuters, would cover electric vehicle components and battery manufacturing partnerships. None of this constitutes a formal trade deal, but the direction of travel is unmistakable. Canada is diversifying its export markets, and it is doing so at exactly the moment when its relationship with the United States is under the most strain in modern memory. Now, here's the part that gets uncomfortable. Remember those US tariffs announced in February? The 25% on goods and 10% on energy? According to Statistics Canada data released in March 2025, Canadian exports to the United States fell by 11% in the first quarter compared to the same period in 2024. That sounds like the tariffs are working, right? They are reducing Canadian imports. But look at where those exports went instead. Canadian exports to China increased by 18% in the same period, according to the same Statistics Canada report. Exports to the European Union rose by 7%. Exports to Japan and South Korea rose by 4% each. Canada is not exporting less. Canada is exporting to different buyers. And here is the uncomfortable math. The United States is not the only customer in the world. It is the most convenient customer because of geography and existing infrastructure. But convenience is not the same as necessity. The question is whether American tariffs are protecting American industry or simply rerouting global supply chains around American interests entirely. We need to talk about what is happening in Alberta, because that is where the ground level reality diverges from the political narrative. For decades, Alberta's oil industry has been almost entirely dependent on the American market. The Trans Mountain pipeline expansion, which became operational in May 2024 according to the Canada Energy Regulator, was the first major infrastructure project designed to change that dependency. It allows Alberta crude to reach the Pacific coast and then ship to Asian markets. According to the Canada Energy Regulator's February 2025 monthly report, Trans Mountain is now operating at 88% capacity. Before the US tariffs, projections had it running at about 70% capacity through 2025. Let that sink in. The tariffs did not cripple Alberta's oil industry. They filled a pipeline to Asia. Industry analysts at RBC Capital Markets, in a note published March 2025, projected that if current trends continue, Canadian crude exports to China could triple by 2027 compared to 2023 levels. That is not speculation. That is extrapolation from existing infrastructure, existing contracts, and existing shipping patterns. But oil is just the beginning. Let us talk about the mineral play, because this is where the long-term consequences become truly significant. In November 2024, the Canadian government released its Critical Minerals Strategy Update, a document publicly available on the Natural Resources Canada website. That strategy explicitly identifies China as a key processing partner for Canadian minerals, while also noting the need to develop domestic processing capacity. Here is the tension embedded in that document. Canada does not currently have the refining infrastructure to process its own lithium, cobalt, or rare earth elements at scale. Building that infrastructure would take 5 to 10 years and require tens of billions in investment, according to estimates from the Mining Association of Canada. China already has that infrastructure, and China is offering to help build it in Canada in exchange for long-term supply agreements. According to reporting from the Financial Times in March 2025, Chinese state-owned enterprises have proposed joint ventures with Canadian mining companies that would see Chinese-built refineries constructed in Quebec and British Columbia. These proposals are under review by Investment Canada, the federal body that screens foreign investments for national security concerns. The United States has raised objections. In February 2025, the U.S. Trade Representative's Office issued a statement expressing concern about Chinese investment in Canadian critical mineral infrastructure, citing potential security implications for integrated North American supply chains. But here is the problem. The United States has not offered a competing proposal. American investment in Canadian mining infrastructure has actually declined over the past 3 years, according to Statistics Canada data on foreign direct investment flows. Canada is being asked to reject Chinese investment without being offered an American alternative. And this is where we have to talk about leverage, because the power dynamics here are not what they appear to be. The conventional assumption is that the United States holds the cards. America is the bigger economy. America is the closer market. America can impose costs on Canada that hurt. All of that is true, but it misses a critical variable. According to the Congressional Research Service, the United States imported $4.3 billion worth of uranium from Canada in 2023. Canada is the primary supplier of uranium for American nuclear power plants. There is no domestic alternative at sufficient scale. The United States imported $23 billion worth of crude oil from Canada in the same year. While American shale production has increased, Canadian heavy crude is specifically suited for Gulf Coast refineries that were built to process that grade. Switching suppliers would require infrastructure modifications costing billions of dollars and taking years to complete. The United States imported $8.9 billion worth of aluminum from Canada in 2023. American aluminum smelting capacity has declined by over 70% since 1980, according to the Aluminum Association Industry Group. The United States does not produce enough aluminum domestically to meet its own demand. So when the United States imposes tariffs on these goods, it is not simply taxing Canada, it is taxing itself, and it is incentivizing Canada to find buyers who will not impose those taxes. Let me bring this back to the specific question at the center of this story. Has Canada actually signed a transformative trade deal with China? As of my knowledge cutoff, the answer is no. What exists are memoranda of understanding covering specific sectors, increased trade flows in response to American tariffs, and ongoing negotiations that have not yet produced a comprehensive agreement. But here is what matters more than the current state of play. The trajectory is clear, and the United States is responding to that trajectory in ways that may accelerate it. According to a March 2025 analysis from the Brookings Institution, American tariffs on Canadian goods are having 3 measurable effects. First, they are increasing costs for American manufacturers and consumers, consistent with historical tariff impacts. Second, they are pushing Canadian exports toward alternative markets, particularly China and the European Union. Third, they are creating political space in Canada for closer economic ties with Beijing, which would have been domestically unpopular 5 years ago, but is now increasingly framed as a necessary response to American hostility. That third point deserves emphasis. Public opinion polling from Angus Reid, Canada's largest public opinion firm, showed in February 2025 that 47% of Canadians now support diversifying trade relationships away from the United States, up from 31% in 2023. American tariffs are not just an economic policy. They are shaping Canadian public opinion in ways that make deeper China-Canada ties more politically viable. So where does this go next? According to the Office of the U.S. Trade Representative, there are currently no bilateral trade negotiations scheduled with Canada. The previous USMCA agreement, which replaced NAFTA in 2020, is up for review in 2026. That review was designed to allow all three parties, the United States, Canada, and Mexico, to assess whether the agreement is meeting its objectives. If current tensions continue, that review could become an inflection point. Canada could seek modifications, the United States could seek modifications, or one party could invoke the agreement's sunset provisions. According to legal analysis from the Canadian Trade Law Centre, published in January 2025, a full withdrawal from USMCA would require 6 months' notice and would revert tariffs to most favored nation WTO rates. For many goods, that would mean higher tariffs than currently exist under USMCA, but lower tariffs than the emergency measures imposed in February 2025. In other words, the current tariff regime is more restrictive than even a post-USMCA baseline would be. The United States is treating Canada worse than it would treat a WTO member with no special trade relationship at all. I want to leave you with a question that does not have a clean answer, because the most important questions rarely do. For 70 years, the North American economic relationship has been defined by integration, shared supply chains, shared infrastructure, shared labor markets in some sectors. The assumption, embedded in every trade agreement from the Auto Pact of 1965 to NAFTA to USMCA, was that American and Canadian prosperity were linked. That assumption is now being tested. If Canada successfully diversifies its trade relationships, if Trans Mountain continues filling with oil bound for Asia, if Chinese refineries process Canadian lithium into batteries that power Chinese electric vehicles, if Canadian canola feeds Chinese consumers instead of American livestock, then the integrated North American economy starts to look different, not overnight, not completely, but directionally. And the question that keeps trade economists up at night, the one that does not appear in official statements or press releases, is this. What if the United States is not just losing a trade dispute, but losing a continent? That might sound dramatic, but look at the numbers. Look at the infrastructure being built. Look at where the investment is flowing, and look at who is being pushed away. The answer to that question will not be clear for years, but the decisions being made right now in 2025 will determine whether we are watching a temporary dispute or the beginning of a permanent realignment. And right now, based on everything that has been confirmed, announced, and documented, the trajectory points in one direction: away.